Gautam, thanks so much for joining in. Was today dominated completely by the India upgrade, and if so, what was your message to clients?
Good afternoon. So the conference went well, but obviously today the upgrade news was the topic of discussion with investors also, and clearly it was a positive message to them as far as sentiment goes. Our message to investors on this news is that the fundamentals behind the upgrade have been fairly well known over last few years, which is macro stability driven by fiscal consolidation, current account, etc. And that has been reflected in the flows into Indian equity markets, in bond markets, has been reflected in yields, in credit spreads. So it's not something which the markets didn't know about. It's only the actual rating event which came in now, and that too from one of the credit rating agencies. So if you look at the credit spreads out there, if you look at the yields out there at which corporates were borrowing from outside India, they were pricing in the new rating rather than the old rating. So the rating is just an event, it's just a reassurance of the macro fundamentals, but in itself does not alter or create a new trajectory for new flows or fundamentals per se. But obviously it's a sentiment positive for investors, definitely a reassuring signal.
Since we probably thought that markets were a bit heavy at these levels, looking at the valuations, this rating upgrade, if you said was already kind of factored in, which means it is also factored into the valuations or the earning projections that you already have. And then do you see further scope for upgrades here on, or do you also believe that probably valuations are on the higher side and it's difficult for markets to move further?
That's been our view and still is the view that valuations are very rich of earnings estimates, which in our view will still be cut while we have seen a credit rating upgrade, but earnings, we are still seeing earnings momentum being negative for India, and even after the second quarter results, the implied earnings growth for Nifty for second half fiscal 18 at 20% still seems very optimistic to us. And on top of that, the fiscal year 19 forecast by the street at 18-20% earnings growth is just way too over optimistic. So we will still see earnings momentum being negative in India, and that would be at some level an overhang on the market, but markets have been ignoring that recently because of strong liquidity and local flows.
Hi Gautam, good afternoon. This is Navneet. I don't know if you remember, I had interviewed you at the start of this fiscal. At that time you had mentioned that demand in India was still normalizing. It had not normalized. We are halfway through, first half is done. How would you sum up the first half of this fiscal, and do you think the second half would be better?
So obviously of this base, there should be definitely better. But again, if you're looking at better in terms of normalizing from a disrupted base, that's a different connotation of what better means versus an acceleration in the economic growth trajectory versus what we have been seeing for last 3-4 years. So I think the forecast out there for GDP growth for next year, for earnings, that seems to us reflective of normalization, while the earnings forecast next year seems to be a very big acceleration in economic activity. So while GDP estimates are building in normalization back to 7.4% growth rates next year, earnings growth at 20% still seems over optimistic and are more aligned with the GDP growing at 7.8% rather than a 7% odd number.
So the disruptions that you are probably referring to in the base period would include the demonetization and GST. If we read the Moody's report, they actually think that both these factors are positive for the economy, and macro fundamentals will actually improve because of both these measures. But looks like, as an equity analyst, you don't really think that the impact is positive.
No. So GST reforms obviously is a big positive. There's no debate about that. But that's something which we didn't need today's rating upgrade to know about. It's fairly well known by the market for the last few years. Markets have been waiting and anticipating this GST reform. And when we look at so even with our cautious stance near term, we have been arguing that the long term structural story of India remains intact, and the reform agenda has been one of the very impressive ones we have seen over the last 3 years, and that's what keeps us hopeful of the long term India story. Despite the near term worries around over optimism of the market, not about the stability or quality of the economy. In fact, we have seen one of the most solid macroeconomic parameters over the last 2-3 years, given the way the policy direction has been. But it's a question of expectations, what the markets are looking at and what is the delta. So markets are building in a strong economic recovery near term. We don't think that will happen, but the longer term story obviously remains solid. There's no debate about that.
As you wind down this conference, what's the central message that investors are going home with? India remains strong, but maybe other economies like Brazil, Malaysia, etc. find favor?
So I think whatever we discussed with many investors, we had almost 100 investors from outside India attending the conference, and we also had a few of them meeting various government officials a couple of days back. So they remain impressed with what's happening on the policy front. What they also vary about the valuations and still lack of a proper pickup in economic activity. And they're still looking for that to play out in the future, because you have to remember most foreign investors are already very overweight India. They have sold a little bit here and there, but India is still the most overweight markets for them. So I think the feeling we get is they are looking for actual earnings recovery to happen, but they're very hopeful and confident of that to play out over the future.
You know, a big concern has been whether the government of India has in fact kind of jeopardized the fiscal stability in an effort to stimulate the economy and support the PSU banks by way of huge bank recapitalization. What do you think is the kind of consensus view emerging from big global investors?
So not really. In fact, they have clearly taken care of concerns around macro stability and fiscal concerns by the way that they have designed the bank recap, which is largely liquidity neutral and does not impact fiscal in the short term. So clearly they've taken those concerns. So I don't think investors are at all worried about bank recap creating macro instability. They would worry if the government starts taking populism measures next year, trying to stimulate the economy pre-elections and drive growth. So that would be a negative. But the bank recap and the way it's been designed to be liquidity neutral, I think that's been taken very positively by markets.
Rising bond yields both in India and overseas was also another concern, maybe a bit related to the risk of fiscal deficit.
Yes, but that's typical short-term markets reaction. Markets do overreact on both sides. They do get over-optimistic and over-pessimistic. So from our cross-asset strategist perspective, in India, we do see the credit side or the bond side, the 10-year now looking attractive. We see equities and FX less attractive, but the bond side definitely looks attractive.
Gautam, just a last question. Well, that's been the common theme. We've been talking to a lot of market participants. The concerns that they've been highlighting from the FI community has been on back of earnings recovery, which so far is not visible, and also higher valuations. But I just want to check, since you're interacting with a lot of FI investors there, are they expecting any more reforms to come by?
They're hoping for more reforms to come by, but they're aware that now we're getting into closer to the election cycle, and we may not see any big bang reforms happen in a hurry, and any further big tougher reforms will possibly happen post elections.